And we typically use this at times of extreme movements to the upside or the downside. Straddles are always perfect when you're going to get extreme movements to the upside or the downside. Always remember that, okay? Because it needs a great amount of volatility for it to drive one way or the other. So let's look at this example. This would be a call, obviously, to the upside. This would be a put to the downside. Yes? Everybody with me so far?
Yes, sir.
Okay, good. Now, let's look at this. Let's say I paid a $1 premium for both my call and my put. Okay, so I've got one of each. Now, what will happen is, and this is, typically pre-market, because if this was during the market, we could also use stops and then get one stopped out and let the other run. So what we could have done, right, and I want you to know this forever because we've been doing this since the day I started, is you would buy a call and a put, and what will happen is one will run and the other will get shut down. You guys can see the drive-in was here. Right now, here's the thing. This is what I always tell you guys. I always say about a week, week and a half, you guys should be buying into earnings. What does that mean? Well, look at how many days we're talking about, right? If you look at each one of these black lines, these are trading days. These are actual market days, okay? So these are all market days that led up to this one. So you've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days. That is 2 weeks for earnings. Okay. So if we're buying up here on the tippity top, anticipating that it's going to continue to go higher, that is a very dangerous game, right, everybody? Remember, anytime we go into earnings, it's going to be a lotto. What do I say is a great strategy to use into a earnings situation? A straddle is absolutely perfect for these situations. And we have a whole training video on this because, right, we either anticipate a bigger move to the upside, or in the case of what this one did, a giant move to the downside. So, what is a straddle for some of you that are new rolling in? This is a call option and a put option, both for the same strike price, both for the same expiration date. And what this does is we get paid on the volatility. Well, what does that mean, coach? Well, if you spent $100 on a call up here, okay, and let's say you spent, because remember, puts cost a little bit more, and you spent $150, right, or 120 or whatever it would be, because remember, puts always cost more than calls, okay? So if we had 100 to the upside, and we'll just, for simplicity's sake, 150 to the downside. Well, you already know today it's down 10%, which means your call just got completely wrecked, but your put took over. And now let's say your put today is worth $300, okay? And you lost 100 on the call, but you only paid 150. So you made whatever the difference is. Does that make sense? So this is kind of right, this is a straddle into earnings play. I love doing these, by the way. I would rather do this than anything else, honestly. But again, you still get time decay. You still have to worry if you're doing short term. Both your call and your put, when you woke up the next day, both were worth less because of time decay, right? All of these things. Now, the other option, of course, is that we always talk about buying a lotto ticket. So if you did think good news was going to come out, right, through earnings, and you thought the earnings plus forecast was going to be great, and you anticipated a move to the upside, well, just like the lotto, you could have put in 50 to 100 bucks or whatever it is to you, right? It could be $10. I don't know, whatever your lotto ticket is. Okay. But you better anticipate it's going to zero, just like when you guys buy a scratch ticket at the gas station.